The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, we're only 2 weeks into the year, and the question has not been resolved. Is this a year of the bear or a year of the bulls? Which way will it go? Yeah, it's kind of like a Goldilocks story. Is it too hot, too cold, or just right? But there's lots of reasons depending on which side of the fence you want to argue from. You're bound to find a list that makes sense. One of which is the market's been going up very strongly, and it's required catch-up for money managers. Virtually every money manager has delivered returns that are less than a highly concentrated portfolio of basically 7 technology stocks.
Correct.
Diversification was not your risk management friend this last year. But in perspective, despite all of the hoopla about the year-end close for both the S&P, the Dow and NASDAQ, when we take some perspective and look back a couple of years, they're basically flat. We have filled a deep hole, but momentum has just kind of been off again, on again. Whipsaw has been the story of the last 2 years, ending up about where we were 2 years ago.
And that's a big part of the story. The whole idea that we like tracking momentum. We like to know where the money's flowing, how markets are doing. And so, last year was great, but like you said, Don, it's coming on the heels of a 2022 that was terrible. And so you just step back just for the 2 years and we're flat. So this year coming up, 2024, it's like, well, if the previous year was a good year, there are many, many times where those good years clump together and you're going to get another one. But just the previous 12 months was horrible in 2022. So what are we going to see? It's going to be one of those track the data. It's going to be day by day, see what else plays out, because there are a lot of variables, a lot of balls in the air right now to be able to tell where we're heading in 2024.
One of which is evident by the fact that the Santa Claus rally didn't extend into Christmas. When the Santa Claus rally came early, Thanksgiving and first part of December, and then it's supposed to be continuing between Christmas and the first few days of the new year. And if that was the case, Santa Claus delivered a bag full of ashes to Wall Street and Broad. It wasn't what everybody was looking for.
Day after Christmas, he was gone, and by New Year's Day, we were looking at not so rosy market outlooks. And like you said, quite frankly, that's been the way things have been going. It's up and down. It's good then bad. It's just back and forth right now.
So the first week of the year was a loser. The second week of the year, first 4 days, looked like things were going to turn around until Friday when inflation news came out. And there was a big bunch of selling. It wasn't quite panic. And it was on the bond market during the day. But by the end of the day, bond traders kind of figured out that the inflation news wasn't going to be all that bad. The high numbers would not persist. So they stayed with the interest rates are coming down scenario. And they ignored inflation higher for longer scenario. So there's a bull and a bear discussion depending on which one you want to subscribe to.
Yeah, and it was a great illustration. If you don't believe that emotion moves the market, those CPI numbers came out just slightly the wrong direction. And man, like you said, Don, people were jumping ship, not at panic mode, but definitely a huge negative reaction. And later in the same day, it was like, you know what, that's really not far off what they said we were looking at. And, it's not going to be a straight line down for inflation. And so maybe this is not quite that bad. But the sell-off in the morning was intense. And that's just emotion and fear driving the market.
And probably exacerbated a little bit by Wall Street professionals basically saying, let's just take some risk off the table, wait for the weekend to settle the news out, and we'll take a look at it. We got a couple of wars going on. Nobody knows what's going to happen with
Right.
those. And of course, we have an election coming up, and the presidential election is a mess. So let's just step back a minute and take some risk off the table and wait.
Why play? Yep.
Kind of depends on your perspective of what's your time frame for being in the window in the market. If your
It's a
window
big
is
one.
relatively short, you can be Mr. Market and have a bipolar investment policy, on again,
Right.
off again. You can be a little more intermediate, or if you're longer term, you look at inflation as Dr. Ed Yardeni and a few other analysts do, who basically say inflation moves in a similar trend year over year. And given that, inflation should be trending down as we move into the year. The data is going to get more confirming and helpful for the Fed to justify a rate reduction.
Right.
So there's a bullish scenario. When will the Fed lower rates is the current question. And the next one
Correct.
is, when will they start raising rates again? Because when they start
Right.
raising rates again, things are falling apart. It's not good news to have the Fed having to step in the market and raise rates.
That's the opposite of what the market needs to see. And right now, at kind of that, we're probably at one of those market inflection points, and that's when things get a little dicey. That's when there are no really clear directions that form quickly, and you need to step back, take a little longer term view, and have a little patience because things are not necessarily um, the data is not necessarily crystal clear on a day-to-day basis. CPI was up, the next inflation number was PPI, the producer price index, that was down. So okay, even that's mixed, and the message is the opposite. Well, maybe inflation is coming down, but it's on the producer price index, so maybe that's going to take a little bit longer. Maybe it is going to come down, but it's going to be a little stickier than we thought when everything was rosy and the Feds were going to start cutting rates in a couple of months. So you have to go a little slower. You have to take a closer look, and don't get sucked in by the daily narrative change in the market.
Well, the producer index has a lag factor to it. So if prices are easing there, they aren't going to pass those savings in cost this directly to the consumer. It's going to take a
They're
while to
not
run
here
run
yet.
through
Right.
the production process and end up at the retail level.
At the retail level. Right.
Yeah, so inflation basically peaked last June, and there are people who said that was the end, and there are others who are saying no, there's still more to come.
Right.
I've been inclined to think that the housing situation, which is a big contributor to the inflation data the Fed looks at, is going to be more difficult to bring down, primarily because of supply issues. Now,
Right.
not everybody agrees with my opinion. Basically, they think that when the mortgage rates start dropping, then there'll be more inventory coming to market from people who have those mortgages that are, let's say, below 4%.
Sure.
I mean, it's pretty tough to sell a house if you have a mortgage on it at 4% and go buy one where you have to take out a 6.5 or 7 mortgage. I mean, that's just not going to be economical. So those people aren't selling properties. They're hanging on to them. They're changing their plans for whatever reason to move. Uh, but because the existing home inventory, let's say occupied home inventory, is really low, it's going to take a big cut, in my opinion, in interest rates before those people are inclined to sell. So the growing inventory that's available for purchase is new construction, and that's keeping the home builders segments of the market doing pretty well. Uh, but that inventory is typically smaller homes, fewer amenities, smaller lots, and builders providing some concessions to help get people in at least a temporarily reduced mortgage rate.
Sure.
So
And like you said, now
will
those aren't instant either. Those are longer flow. that information lags coming into the inflation calculation, and things like more people buying houses and having more homes to purchase, those are time consuming things. Those are things that don't happen instantly. It takes a while to gear up and get that stuff going. So that says inflation on from the real estate side probably going to hang in there for a little while.
So it has impact on major wholesale retailers like Lowe's and Ace Hardware and Home Depot.
Sure. Yep.
Because if you're buying a home that's been occupied by somebody else before you get there, well, you come in and say, well, let's replace the carpet, let's replace the appliances, let's put new drapery up. I don't like
Why
the
in the world
landscape.
is that wall orange? Yeah, who did
That's
that?
right.
We gotta fix that right now. So
But if you're buying a brand new house, the odds are you probably told the contractor what you wanted. So
sure.
there's less reason for business being driven through the hardware stores. Those take buyers of pre-existing housing, and that's until that reverses as far as the supply chain. I think that housing is going to be slower in the inflation numbers, slower in the decline, and
Hmm.
home prices for those who own them are not going to collapse like they did in '08 and '09 from the mortgage debacle that we had. We don't have
Right.
that kind of erosion going on in the housing market.
That's a really
But
good point. It's not the
the,
same.
bo-
Yeah.
the bottom line here for 24 is that the Fed's going to be the primary driver of the market. What does the Fed do? If the Fed says, yeah, we thought we'd cut rates by now, but we aren't because inflation's higher for longer than we expected, then we're going to see another period of soft market prices. If they cut earlier than currently expected, we're very likely to see speculation re-enter the market and retail investors start to drive prices again. Right now, it's a coin flip on which one's going to happen.
It is important to keep in mind that those rate cuts are already baked into market prices and market forecasts. The Wall Street believes that those Fed rates are going to come down, and if that does not materialize, that is not going to be met with fanfare on Wall Street. Probably going to take a hit in the market. And when you say softer markets, Don, that means we're gonna see a pullback if that doesn't come around. And even if the Fed delays lowering rates, it's all going to be what did they say? Are they going to lower rates? Do they think it's coming sooner or later? And that'll kind of set the degree. But things are going to slow down on the market if those rate cuts don't come in March, which is
So
the
what,
expectation now.
but historically, when the rate cuts come, it's because they normally are dealing with a slowing economy and they're trying to
Correct.
stimulate it.
Yep.
So, and a slowing economy means higher unemployment. Theoretically, you should get a drop in inflation as consumption subsides,
Goes
but
down.
those
Yep.
things aren't happening.
They're
And you're
not
saying,
happening.
why would anyone wish for a recession?
Yeah.
Why do you want unemployment to be higher? That's not good for the economy. The fact is, we can have strong growth and modest inflation. It's a function of policy. And right now, the policy is messed up. It is not supportive of strong growth with low inflation. The government intervention has been a detriment to getting that job done. The other thing that's going to happen this year is most likely is we're going to see the Magnificent Seven turn into a little tarnished metal.
Right.
The the speculation over the last couple of years on the benefit of AI is pretty well topped out as far as the majors are concerned, the major players. But AI is going to benefit the rest of the country. Whether you are
No doubt.
manufacturing a hard product or you're providing services, AI is going to make your business more efficient. We just don't know exactly who the major beneficiaries are yet, but they will become leaders in their industries and they will become evident over time and probably leave the Magnificent Seven kind of on the not quite on the shoulder, but in the slow lane.
Sure. And in a situation like AI, where we know we have, a world-changing technology coming online finally and showing up where the retail market is going to be able to benefit from it, almost every kind of employee is going to, excuse me, begin to use it. And you really can't tell who the winners and losers are going to be at this point. And some of the Magnificent Seven are going to get it right, some of them aren't. And then there's going to be some new companies come along that just leapfrog everybody and disrupt the entire sector. So it's a time to be on watch for that. And as always, don't make too big a bet in one direction. There's no such thing as, well, this company can't lose. They can. So be careful out there. Don't get too excited and overreach on the AI in particular, because like you said, Don, winners and losers are going to become very apparent. They're going to be sorted out, but they are not yet.
So there is a time lag on all this economic data and what the Fed is watching for. You just have to be patient
Sure.
and not not get so frustrated that you've missed out on the last year, but be patient looking for where leadership is going to be, where it is developing. And that's what we do as money managers is we're looking for leadership. We're not married to any one position. And when leadership changes into a lag, comes out of a portfolio. If you'd like more information on how we do that, contact us. The contact information is coming up on this next screen. If you haven't subscribed yet, do so. Click the button down below. Have a happy and a prosperous new year.